Hey there, future accountants. Ever wondered why non-cash losses are such a big deal in accounting? Let's dive into it. Non-cash losses are accounting expenses that reduce a company's earnings but don't involve any actual cash payment. They're essential for companies that use accrual basis accounting. Let's go through some common examples. First up, unrealized losses. These are losses that haven't been realized yet. Imagine you have stocks that have decreased in value. You haven't sold them, so you haven't actually lost money, but on paper, it's a loss. Next, asset write-downs. This happens when a company reduces the book value of its assets. It's like acknowledging that your car isn't worth as much as it used to be. Depreciation is another big one. When a company buys an asset, like machinery, it spreads the cost over the asset's useful life. Even though the money was paid up front, the expense is recorded over time. Then there's amortization, which is similar to depreciation but for intangible assets like patents. The cash payment has already been made, but the expense is recognized over the asset's useful life. Lastly, gains and losses on asset sales. These are considered non-cash charges because they relate to long-term assets purchased in previous periods. For example, if you sell a $100 asset for $80, you record a loss of $20, even though you're not losing $20 in cash right now. Now, why do these matter? Non-cash losses are accounted for as deductions on the income statement, which lowers a company's overall earnings. This helps provide a more accurate picture of the company's financial health. Let's break down gains and losses a bit more. You record a gain or loss when you sell an asset for a price that's different from its book value. If an asset is listed as $100 on the balance sheet, but you sell it for $80, you record a loss of $20. Conversely, if you sell it for $120, you record a gain of $20. Many companies have a line item for gains and losses on the cash flow statement, usually near depreciation and amortization. But why are these non-cash adjustments if the transaction involves cash? It's due to timing differences. These gains and losses correspond to assets purchased in prior periods, not the current one. So if you sell a $100 asset for $80, you record a $20 loss on the income statement, but you're not literally losing $20 in cash this period. It's a cash loss relative to what you paid for the asset long ago. The income statement and cash flow statement show only what happens in this year, so we count this as a non-cash adjustment. In cash flow from operations, we add back the $20 loss, then in cash flow from investing, we subtract it again and show the book value of the assets sold, so that $80 shows up in cash flow from investing. The logic is similar for gains. If you sell a $100 asset for $120, it doesn't count as a real $20 cash gain in this period. We subtract the gain in cash flow from operations, then add it in cash flow from investing, showing the book value of the assets sold. Understanding non-cash losses helps you see the bigger picture of a company's finances. So next time you're looking at financial statements, remember these key points. Thanks for watching and happy accounting.